So, what if I told you the key to building real property wealth wasn't actually in Sydney or Melbourne, but thousands of miles away, in the desert? It sounds a little crazy, right? Well, today we're diving into a really interesting article that compares Australia and Dubai. And look, for any investor who's feeling the squeeze down under, this explainer is going to break down exactly where the biggest opportunities, and yeah, the risks, are hiding for 2026.
Yeah, if you're an Aussie investor, this question probably hits pretty close to home, doesn't it? I mean, sky-high prices in cities like Sydney and Melbourne, that's been the story for years. And trying to find a property that actually gives you a decent, positive cash flow, it can feel like you're chasing a ghost. So you have to ask, what are the other options?
Okay, just look at this for a second. The difference is, well, it's huge. Over in Australia's big cities, you're lucky to be getting around 2 to 4% in rental yields. That's your return. But then you look at Dubai, and you're starting at 6 to 8%, and believe me, in some spots, it goes even higher. We're talking double, maybe even triple the income stream. It's not even in the same league.
All right, so let's dig into the core issue that's really driving this whole conversation. We're calling it Australia's property problem, and it gets right to the heart of why so many local investors are starting to look beyond their own shores for better returns.
You know, it's a pretty simple formula when you think about it. The price to buy a property is through the roof, right? So you absolutely need strong rental income to make it all work. But as we just saw, the rental yields in Australia's main markets, they're just not cutting it. That squeeze on your returns is the #1 reason investors are being forced to look elsewhere, for markets that just make more sense financially.
Okay, so let's switch gears and look at why Dubai is turning so many heads. The source material calls it a tax-free solution, and that's a pretty big claim. So let's break down the key financial perks that are pulling in all this Aussie capital.
First up, let's go back to those rental yields. We're talking a range of 6 to as high as 13% for gross yields in Dubai. And gross just means that's the total rent you're pulling in for the year before you take out any of your costs. Honestly, a number like that is practically mythical in today's Australian property market.
And here it is. This might just be the biggest reason of all. Zero. A big fat 0%. In Dubai, you pay no income tax on the rent you earn. And when you decide to sell, no capital gains tax. Let that sink in. Every single dollar of profit you make, you keep. Compared to how things work in Australia, well, it's a completely different world.
And you know, it's not just about the money. There's another really powerful incentive on the table. If you invest around 700,000 Aussie dollars into property, you can qualify for Dubai's 10-year golden visa. And this isn't just some tourist visa. We're talking long-term residency for you and your family. It adds this whole other layer of lifestyle and security to your investment.
You know, the source article really hits the nail on the head with this quote. It's so direct and so powerful. The idea that every single dollar you earn from rent goes straight into your pocket with no tax man touching it, that's really the core of what makes Dubai so attractive to investors.
And this chart just lays it all out so clearly. I mean, look at the side-by-side comparison. We've talked about yields and tax. Dubai, it's a clear winner there. But check out ownership rights. In certain areas, you get 100% foreign ownership. And then there's the buying process itself. Often you can do it all remotely with digital contracts. That's a world away from the longer, in-person process you're used to in Australia.
Okay, so let's say the numbers are looking pretty good to you. The next question is obvious. What do you actually invest in? So now, we're going to break down the two main strategic choices you'll need to make if you're looking at the Dubai market.
First up, it's the classic apartments versus villas debate. Think of it this way. Apartments are your cash flow kings. They generally have higher rental yields and a lower price to get in. On the other hand, villas are all about long-term capital growth and stability, since they tend to attract families who stay for longer. And that stronger value growth point? Get this. The source article mentions that prime villas have seen their values shoot up by over 90% since 2020. That is just incredible.
Your second big choice is whether to buy off-plan, that's before it's even built, or a property that's already ready. Buying off-plan can be tempting. You get in at a lower price, and you can make a lot of money as it's being built. But buying a ready property gives you peace of mind. You can see exactly what you're getting, and you can rent it out and start earning money from day one. It's that classic trade-off, risk versus reward.
Now, we mentioned this word freehold earlier, but it's so important we need to really be clear on it. Freehold is basically the magic key that opens up the Dubai market to foreigners. It means that in specific zones, an Aussie investor can own the property and the land it sits on 100%. You get the same kind of ownership and security you'd have back home.
Okay, but it can't all be sunshine and tax-free rainbows, right? Of course not. Every investment has its risks, and it would be crazy to ignore the other side of the coin. So for a fair picture, we've got to take a realistic look at the challenges and complexities of investing in Dubai.
The source points to 4 main things to watch out for. First, the market can be volatile. Prices can swing up and down pretty quickly. Second, the legal side of things can be tricky for foreigners to navigate. Third, you've got to watch for hidden costs. Things like service charges can actually gobble up as much as a quarter of your rental income if you're not careful. And finally, yeah, if you buy off plan, construction delays can and do happen.
So the big question is, how do you handle those risks? Well, this checklist is basically your roadmap. It's all about doing your homework. You got to check out the location, research the developer's reputation, understand the legal stuff, and really look at the market data before you even think about signing on the dotted line.
All right, so we've weighed the pros, we've looked at the cons. What's the final verdict for 2026? Let's pull it all together and see what the near future might actually look like for the Dubai property market.
Well, the forecast for 2026 is actually showing the market cooling off a bit, settling into a more stable growth of between 5 and 8% a year. Now, after the crazy price jumps they've seen, this is actually a good thing. It points to a market that's maturing, which is exactly what long-term investors want to see: steady, sustainable growth.
And really, that's the takeaway from this whole explainer. The core reasons to invest in Dubai are incredibly strong. You've got that tax-free income, you've got the high rental yields, and you've got more and more people moving there. But all that potential comes with real risks that you absolutely must investigate and understand before you jump in.
Which brings us to one final big question. With the old path to property wealth in Australia getting tougher and tougher, could looking overseas to a place like Dubai actually be the new Australian dream for investors? Well, as we've seen, the answer really comes down to your own personal strategy and just how much risk you're willing to take on.